Okay, you know we have been following the bond market and explaining why the rise in the 30-year Treasury yield is a big, bad warning sign, which is why I want to explain why Stan Druckenmiller's piece in the Wall Street Journal titled "Let the Bond Market Speak" is absolutely huge. Okay, you might not know Stan, so let me just be patient with me. Treasury Secretary Scott Bessent worked under Druckenmiller at George Soros' firm for years. Most recently, Fed Chair Kevin Warsh worked alongside Stan for the last few years. Stan Druckenmiller, you can like Wall Street, hate Wall Street. He is one of the greatest living investors. This man is not a big attention speaker. He does very little media, and he has never touched a tweet. But the fact that he has come out with such an aggressive public rebuke of Bessent's actions to bring down long-term interest rates on 30-year bonds is enormous. When I say on this show that the bond market is the real daddy, the daddy I'm talking about is Stan. If you have not read this piece, I encourage it. But here are the punchlines. And I say punch because, as I said, this is a very public punch to Bessent's gut. Quote, "I have spent 5 decades trading on a simple premise. Markets aggregate information no committee possesses, and prices are how that information reaches decision makers. The long-term Treasury yield is the most important price in the world. It is also the only fiscal disciplinarian the U.S. has left," end quote. Stan, a longtime advocate of entitlement reform, pushes back on Bessent's moves, especially hard here, and says the steps Bessent is taking amount to procrastination, putting off what really must be done to meaningfully address U.S. debt. That means reforming Social Security and Medicare. That means creating a responsible budget. He lays out how Bessent and the government have not only given the game away here, but they, like Trump on trade and Iran, have again misunderstood their power and influence and will quickly learn that they have miscalculated and cannot impose their will on others with the might that they think they have. He closes the piece reminding Bessent that he will lose in his efforts to bring down interest rates. Quote, "Governments defending prices against fundamentals always lose. The only variable is how much they spend before conceding." As he puts it, let the bond market speak. The question, will Bessent or any political leader, Republican or Democrat, actually listen? As I said, this is huge, so let's discuss. Scott and Bharat are still here. Scott, I guess I'm like underlining, circling, putting 4 exclamation points because I am not sure that an audience outside Wall Street understands sort of the weight of Stan Druckenmiller's words. We've watched Scott Bessent over the last 2 years blow off his critics, act like they don't know better, they're novice. I remember I saw an interview a year ago where an interviewer was laying out Goldman Sachs reporting data on how the tariffs work, and Bessent was basically like, Goldman Schmoldman. He cannot say that about Stan Druckenmiller. No way, no how. What do you make of this?
Yeah, I thought it was a fantastic piece. And, you know, as I'm reading it, I'm thinking of the classic Meatloaf song, "I'll do anything for love, but I won't do that," because that's really, it seems, where the Trump administration is. They'll do anything for yields except controlling the debt, except addressing taxes and spending and entitlements, like, of course, they promised to do. You know, when Trump took office again, the responsible guys were going to come in and they were going to tackle the debt situation. And that's what Bessent promised as well with respect to bond yields. And instead, we got a bunch of tax gimmicks in the One Big Beautiful Bill, some good tax policy, but a lot of more kind of spending through the tax code. And we've gotten no spending reform. And when you look at the long-term fiscal trajectory of the United States, where mandatory spending, so interest and mandatory spending are now exceeding our long-term revenue rates as a share of GDP, it's a spending problem, and nobody in Washington is willing to tackle it.
Bharat, what do you think?
Well, I agree and disagree with the op-ed. I agree with the fact that the market has rendered its verdict on Trump's policies. You know, when he took office, the 30-year rate was 4.8%. Now it's 5.2%. That may not sound like much, but that's a pretty big upward move in the rate. And it's the market rendering its verdict that the Trump administration has worsened our fiscal position, which is not surprising if you look at any of the other data. Where I disagree with the op-ed and disagree with Scott is on the cause of this. So if you'll indulge me for a little bit, if you go back to 2000, If we had the tax code today that we had in 2000, the debt would actually be flat to declining. That's even with the projected increase in costs on Medicare and Social Security, because we knew back then that we were going to have more retirees, but we had a tax code that was ready to accommodate it. What's happened in the last 25 years is that you've had repeated tax cuts under George W. Bush and then Donald Trump, largely skewed towards the wealthy, and that has substantially reduced the amount of revenue that we bring in each year as a percentage of GDP. So I think the irony of this op-ed is that while I agree with Druckenmiller's diagnosis, I think the solution is actually for people like Stan Druckenmiller to start paying more in taxes.
Scott, what do you think?
Yeah, I don't disagree that there are some reforms that could be made to the tax code that might help a little bit on the revenue side. But the fact is, for about 50 plus years, revenue as a share of GDP has hovered between 15 and 20%. The United States has sort of a resistance to anything above that. And meanwhile, while revenue has remained basically flat over that period, spending hasn't. And until you tackle the structural issues that drive mandatory spending ever higher, and those structural issues are entitlements, the fact we have a lot more old people today than we used to, and you have a lot fewer workers paying for all these very generous entitlements, until you handle that fundamental issue, you're going to have a debt problem no matter what tax policy you have.
All right, let's move on just quickly before we go. Scott Bessent also said yesterday that the Treasury Department has not bought back a single bond yet. Bharat, what does that tell you about his plan to manage the U.S. debt?
Well, I think that maybe he's hoping to talk the market into bringing yields down. I'm not quite sure, how he's trying to play this. In many ways, it reminds me of what's going on with Iran, where he's announcing something and maybe hoping that that will induce behavior. And so he doesn't actually have to take the final step towards doing it. But I'm sorry, I can't let Scott's final point go unanswered. He makes it sound as if 20% of GDP and 15% of GDP on revenue is about the same. No, that's not true. That's about $2 trillion a year difference. And the truth is we were at 20% in 2000. We're closer to 17 or 16% right now. And that's the difference. That's the ball game in terms of the trajectory of our debt. And so, look, if folks want to start talking about cutting Social Security or Medicare, I think that would be a bad course. It'd be very politically unpopular. We can sustain the entitlement obligations that we have as long as we go back. All we have to do is go back to the tax code we had in 2000, which largely means restoring taxes on the very wealthy.